Hi everyone, this is Pete here. So this is the second part of the current US bank failure fallout. So the thing that I want to discuss here is this. Many people have been asking, hey Pete, you talk about using your US brokerages, and one of the main one that I actually talk about is also known as Thinkorswim, which is by TD Ameritrade. And the concern is, hey guys, will TD Ameritrade go down as well? Okay, so today I want to talk about, in particular, the parent company of TD Ameritrade, which is actually known as Charles Schwab. Okay, so for those of you who don't know, actually TD Ameritrade is owned by this company called Charles Schwab, right? So the question is, will Charles Schwab be safe? Okay, so let's take a quick look here. Now, first and foremost is we must understand, right? Like how did Silicon Valley Bank die, right? How did it go bankrupt? How did it run into insolvency? It's basically it had this issue of a bank run, right? Not this Silicon Valley Bank, but this Silicon Valley Bank. Okay, all right. So the question is, will Charles Schwab also face a bank run like Silicon Valley Bank? Now, first and foremost, let's look at what is Charles Schwab. Right, Charles Schwab actually is one of the largest online brokerage in the US right now after they have acquired TD Ameritrade, up to $7.4 trillion of investors assets, and on top of that, right, they have about 34 million brokerage accounts. And out of all these monies, right, actually they put about 80% in bank deposits that are FDIC insured. Okay, so what is FDIC insured? It's very important is that the bank accounts in Charles Schwab, right, they are insured up to $250,000. And if you have an account with Charles Schwab or TD Ameritrade, you are also insured, right? Not by FDIC, but another IC, which is SIPC, okay? Right, which is in charge of securities and stuff like that. And it's insured you up to, wait a minute, even higher, $500,000, $500,000, right? So basically, if you have money with Charles Schwab in their brokerage account, right, and you have anything less than $1 million, all right, the cash limit is 250, of course, right? Then you have nothing to be worried about, to be honest, right? You are backstopped by the government already. And in fact, right now, you can see that for Silicon Valley Bank, those with more than $250,000, the government is also backstopping them. Okay, so that's the first thing is that if you have money with Charles Schwab, even if they collapse, right? If you have less than 250K or together with your securities is less than $500,000, you have nothing to worry about. Okay, now this is a thing that I pull out to show you that the total protection is capped at $500,000. Okay, all right, cash and security each capped at $250,000. Okay, all right. Now let's compare Charles Schwab, which is SCHW, versus SVB, Silicon Valley Bank. What are the differences in this case? Okay, number one is that SVB had a lot of customers, right? They are under the private equity and startup companies category, right? They are the major deposit customers, and more than 90% of them, right? Because they put in such a huge amount with Silicon Valley Bank, they are actually not insured by FDIC because they are more than 250K. Whereas Charles Schwab is very different, right? So when SVB, what happened is they had a bank run when some of these companies started to pull out from them because they know that they are not insured by FDIC, so they have to protect themselves. But Charles Schwab is very different. Charles Schwab is actually a more mainstream brokerage come bank, right? It has customers pull from different segments, and in fact, more than 80% of their deposits, right, are FDIC insured. That means they are less than 250K. So that means there's very low likelihood that firstly, people are worried about the money in the bank because it's insured by the government. And more importantly, because each bank account is such a small number, right, such a small quantum, even with some of them were to pull out, the impact on Charles Schwab will be quite low. Unless there is a systemic spread of fear where all the retail deposits are all pulled out from Charles Schwab, right? Now, the thing is this, so essentially, will Charles Schwab face a bank run? Now, honestly, you must understand the fact that, anybody have the risk of failure if the customer pull out all their money in the very, very short term, okay? But the thing is, if you have less than 250K or you have less than $500,000, you are fully backed by FDIC and SIPC. So in this case, I think the chances of Charles Schwab facing a bank run is relatively low, okay? And on top of that, right, so if you have less than this amount, you don't have a bank run risk. But on top of that, one thing is this. We want to talk about another issue that killed Silicon Valley Bank. which is not just that people were pulling out money, but also the fact that they were trapped by this bond issue, right? What's this bond trap? Let me explain again. For those of you who did not watch my previous video, please go and watch the previous video. But essentially, let's say, right, if your bond yield were to go up by about 2%, okay, and assume in this case, your bond price will drop by $5, okay, because bond yield and bond price are inversely correlated. So what happens is that if the bank bought these bonds, right, your unrealized loss at this juncture is $5, okay? So if there's a bank run and, you know, Charles Schwab run out of liquidity, they might be forced to sell this bond at a huge loss, at a $5 loss. And this is what happened to Silicon Valley Bank, right? In fact, they did not just lose $5 per $100. They lost about $20 per $100 because they had to meet all these withdrawals, right? So what they did was they had to sell all these bonds at a loss to shore up liquidity. So Charles Schwab potentially can be in this situation, right? But the thing is this loss technically will not be realized, and it will never be realized if the bond is held to maturity. Why? Because these are actually government bonds. So if they are held to maturity, actually they'll get the full $100 back. So even if in between when they bought the bond, the prices go up, down, up, down, up, down, up, down, at the expiration date, right, it will still give them back the same amount, which is $100. All right, so let's take a look at Charles Schwab's reports over here, right, when they announced in earnings. And the main focus I want you to focus on, right, is here, right? It talks about available for sale securities and held to maturity securities. And you can see that there are huge amounts, right? Close to $200 billion of available for sale securities and $146 billion of held to maturity securities. So about $146 billion of all these bonds, okay, that they are saying that they'll potentially hold to the end of maturity. Hey, but guys, if you're forced to sell, you're forced to sell, right? So how do we know that Charles Schwab is in no risk of selling, right? Now let's take a look. Even with, although they are saying that they will hold to maturity, right? They are quite honest. They actually show you how much unrealized loss they are facing right now. Okay, so you can see over here, right now, the held to maturity unrealized loss is about $15 billion. Whereas the available for sale security is about $28 billion. So if they were to force to sell all their long-term bonds, all right, they call it mortgage-backed securities, right, they will face a $15 billion loss. But the question is this, will they be forced to do it? Now, this is where it is very important to understand the government, because right now, the government, they are pulling out all stops to protect everybody, be it your small retail banker, depositor, or you're a big company that put money with these banks. Okay, so and they call it the what? They call it the Bank Term Funding Program. And it says they will offer loan up to 1 year to the lender, okay, to pledge collateral, including treasuries and other qualifying assets, which will be valued at par. That means if, right, Charles Schwab really faces a liquidity crunch, okay, and they really need to sell all these assets, they don't have to. Right? They can just go to this funding program and say, hey, I need to borrow some money based on my US treasuries, right? And they will value them on par value, that means they will value them at the original purchase value of, let's say, $100 instead of the current 95. Okay? All right. So this is very, very important because the program says it will eliminate institutions needing to sell those securities in times of stress. Right? And it will be enough to cover all uninsured US deposit. Okay, so this is the program that the government has already set in to protect companies like Charles Schwab. All right, and last but not least is this. Charles Schwab even show you out of all the fixed maturity bonds, right? How many of them will come to maturity? And in fact, Charles Schwab will get about $20 billion each year for the next 5 years as it slowly matures. So this tells you how prepared Charles Schwab is, right? So even if they have a bank run, firstly, government is protecting them. But secondly, they have quite a huge amount of balance, right? Liquidity to support this, to make sure that they tide through this period. Okay, so last but not least, let me just share with you guys what is Pete doing, what am I doing. Number one is I am buying quality names during this period, which have fallen, okay? And just full disclosure, right? I think Charles Schwab is definitely one of the quality names. So this is where it really, tests you as an investor, whether you have the iron in you to really buy something, right? That is good quality, but the price is so cheap and it's done by everybody, right? When there's maximum fear, there's maximum profit. Number two is that I want to highlight to you guys, right, that Charles Schwab is very attractively valued right now because it is valued at, drum roll, right? Firstly, price to earnings is at 14 times. 14 times. Take note, the 5-year average is 22 times. Right? So that's pretty strong, very, very big discount, Okay. And this is the last slide I want to share with you guys is that right now the market, in my mind, is that with this whole banking collapse, a lot of the good companies, especially good banks, they are on fire sale, right? Now, just think about it. If the government is willing to backstop a small-ish bank called the Silicon Valley Bank, if something very big happened to, let's say, a major bank like Charles Schwab, Citigroup, JP Morgan, do you think they will not backstop them? Right? So this is really the kind of moral hazard that the Federal Reserve have created, but in a way, it serves as a very good protection for investors like us who wants to invest in good value companies. All right, so that's all I have to share with you guys. I hope this is useful, and for those of you who have money in TD Ameritrade, I hope this gives you more information before you decided to make a drastic move about your investment in TD Ameritrade. All right, that's all I have, and I'll see you guys next time. Bye bye.